This is a simulation of a planned 7-kilometer long bridge in the Maldives that will link its capital Malé with the islands to its west. It will cost over $500 million to build and will be funded by India. However, on the other side of the capital, you can find the just finished 2-kilometer long China-Maldives Friendship Bridge that has been funded by China. And this is no coincidence. In fact, it seems to be part of a trend where India is basically trying to drive Chinese money out of Southern Asia by providing its own money as an alternative. For example, while Chinese loans famously helped build mega projects all over Sri Lanka when its economy crashed last year, India provided over $4 billion in loans to Sri Lanka, while China only provided $1.2 billion. Furthermore, while Bangladesh was just a few years ago one of the key recipients of Chinese money to build new rail lines and bridges, its finance minister recently warned other nations against borrowing too much from China. And now, these latest rail infrastructure projects between Bangladesh and India are funded by India as part of its 2022 $8 billion funding package. So, what's going on? How does India plan to drive Chinese money out of South Asia? And does it have any chance to succeed? Well, to answer these questions, we need to ask ourselves, why did India draft this plan in the first place? In other words, what is India's problem with Chinese money in South Asia? Well, that has everything to do with a history of political rivalry between these two Asian superpowers. But before getting into their problems, let me just tell you about your problem with people selling your personal data on the internet by introducing today's sponsor, Incogni. You see, commercial data brokers aggregate your personal data from the internet, including employment history, home address, or SSN, and sell it to all kinds of businesses. For example, health insurances might purchase this data and raise rates based on online search activities. Similarly alarming, some data brokers have been caught selling data to scammers. Ever wondered why you get thousands of spam mails that you never signed up for? Now you know, and while you have the right to request data brokers to delete your data, it's so complicated that it would take years to do it manually. Luckily, there's a solution: Incogni. Incogni will reach out to data brokers on your behalf, demanding your personal data removal and even dealing with any objections from their side. All fully automated. If you want to try it out, the first 100 people can use my personal discount code MONEYMACRO to get 20% off. Just check out incogni.com/moneymacro and take your private data off the market. But first, let's get back to why India wants to remove Chinese money from South Asia. Well, a key component is that China's rapid growth has been quite threatening to India. You see, while both economies used to be similarly sized in the early 90s, China has since overtaken India to become Asia's biggest economy by far. This allowed it to embark on a massive lending spree under the name of the Belt and Road Initiative. Under this name, China has been lending billions of dollars to the nations that you see here on this map. Notably, this includes many of India's direct neighbors such as Bangladesh, Sri Lanka, the Maldives, Nepal, as well as its rival, Pakistan. But why? Well, according to Professor Andreas Fuchs, head of the Kiel Institute China Initiative, China's motives for providing these funds to recipient countries are both selfish and selfless. First, it uses the funds as a foreign policy tool to incentivize countries to support it on the global stage. Second, it uses them to promote trade links with China. And third, given that it does give more to poorer nations, it does also seem to quite selflessly want to reduce global poverty. And let's be honest, while it is less transparent about its loans, China's motives are not all that different from the motives of Western countries that traditionally occupy this space. However, Chinese money is especially threatening to India given the history of violent rivalry between the two countries. The main culprit is the border between the two countries, also known as the world's longest disputed border. And while the conflict seemed to have stabilized after a border war in 1962, recently violent skirmishes have once again occurred between both armies. So, with that context, Of course, it was quite threatening to India when lots of Chinese money started to flow into neighboring countries. After all, countries receiving Chinese money suddenly stopped criticizing China on the international stage. What's more, some of these countries started appearing on top of several lists for potential candidates for future Chinese military bases. But luckily for India, China's economy has recently started slowing down, and India is more and more seen as the neighborhood's upcoming giant. The country is soon to overtake China as Asia's most populous nation, and while it is much poorer, the IMF predicts that India's economy will grow quite a bit faster than that of China in the upcoming years. And that gave India the financial means to draft the plan to drive Chinese money out of South Asia. Now, this plan doesn't have a catchy name like China's Belt and Road Initiative, but what it does have is money. Lots of money. In total, development lending was scaled up from 55 billion since 1947 to 107 billion since 2014. And while India's government officially tries to play down that this is a reaction to the Belt and Road Initiative, economists have actually discovered that India's state-owned bank was significantly more likely to finance projects in a country if the Chinese government had provided finance there within the previous year. What's more, this dynamic was even stronger where China had made public opinion gains relative to India. And sure, total Indian aid isn't that much if we compare it to China's Belt and Road Initiative, which was around 838 billion. However, China's Belt and Road money is spread over a much larger area. So, for countries in South Asia such as Sri Lanka, recent Indian money flows are now already making more of a difference than recent Chinese money flows. And this is already benefiting India politically. Not only has Sri Lanka's government recently announced a host of new projects that will benefit trade with India, public opinion in the country has also shifted somewhat in favor of India and against China. However, China's large pool of outstanding loans to Sri Lanka still mean that Sri Lanka continues to have a large interest in keeping China happy as well. What's more, during their recent crises, China has extended more and more emergency loans to India's troubled South Asian neighbors. And this got me wondering, does India's plan actually stand a chance? Well, I think it's actually extremely unlikely that India can drive Chinese money out of South Asia completely for three main reasons. First, India's economy is still much smaller than China's, and even if it is projected to grow faster, it will take quite some time to catch up. Second, given that India has a substantial trade deficit, it needs to attract foreign funding to finance its imports. Now, this does not mean that it cannot provide a lot of funding for others. After all, current account deficit countries like the United States and United Kingdom are among the biggest contributors when it comes to development finance. Still, it does mean that India needs to borrow itself to do so, and that means that it has a higher risk of getting into financial trouble itself than, for example, China. And this could motivate it to be more careful with foreign loans than China. The third reason that Indian money is unlikely to drive Chinese money out completely is that we shouldn't forget that India's neighbors have a voice in all of this. I mean, many of them might actually welcome a competition between the two powers about who can get the privilege of funding them. After all, this might mean that they can get loans on more favorable terms. What's more, some neighbors, like Pakistan, have their own border disputes with India, meaning that they vastly prefer Chinese money to prop up their troubled economies. That being said, there are also three reasons that India's plan might succeed in the long run. The first reason is that with a lingering financial crisis at home and with many current international projects already in trouble, China is already scaling back its ambitions for the Belt and Road Initiative. The second reason is that India has found a way around its limited official resources by convincing some of its extremely wealthy private sector tycoons to finance India's interests abroad. And the final and third reason is that if the projections are right, that India's economy will grow quite a bit faster than that of China for the foreseeable future, then I think it is likely that Indian development finance will at least start balancing out Chinese money in South Asia. But yeah, that is my assessment. What do you think? Does India's plan stand a chance? Let me know in the comments section or consider joining my Patreon to support my independent analysis and gain access to an exclusive Discord server where you can discuss this in more depth with me. Finally, if you want a refresher on Sri Lanka's crisis, check out this video over here. Or if you're interested in why international finance by Western private companies can also be quite dangerous, check out this video over here.